recording that time. So that's the theory. What's the evidence like? Well, if you take a look at some of the data, you get, if you look at the Dow Jones over time, you get an extremely volatile curve, but if you were, drunk enough, you might argue at a pub that that's an exponential trend. But if you look more closely by taking logs and seeing what you actually get, then there's still, of course, a rising trend, but pretty damn massive volatility as well. But up in 1995, except for this wonderful dip here, that's a 90% fall in the index, by the way. That's how much the index fell from 1930 to 1932, 33. So now when you look at the timing of all this, Sharp's paper was published then, using data that only went back to the post-war period, the early post-war. So the initial research actually coincided with a period that Minsky described, and we'll talk much more about Minsky in future lectures, as a period of financial tranquility, when debt levels were very low and there was low levels of speculation on the stock market. But that was rising over time as people's memories of what happened during the Great Depression receded, and as people who experienced it died, and new people came on who hadn't been through any of it. So you had steady growth at the time as well, high employment and low inflation. Inflation was generally below about 3 or 4% in America. Unemployment was about 4 to 5 of that region. Australia, unemployment was down below the 1% level. And you had in the Dow Jones, there was a steady advance from 49 to 65. So in 1949, it cracked 175 points. About 17 years later, it's almost 1,000, which is a pretty massive increase over 17 years. And that increase continued around the time of Sharp's paper, which is before 66. Then from that stage on, though, from February 9, 1966 on, prices were almost stagnant. And it didn't go anywhere. In fact, had a crash between 65 and 82. So in 1965, it cracks 900. In 72, 7 years later, it's still below 900. Okay? Now that's a zero return in nominal terms for 7 years. And by that was a period of rising inflation. So you had falling stock values in real terms. Then 72, it cracked 1,000, so we're finally through the 1,000. What happens next? It plunges. It peaked at 1,052 in January of 1973, and most people tend to forget this. There was what really qualifies as a major bear market, a major crash in the market between 73 and 74. It fell 45% over a 23-month period, and then it stagnated for another 7 years. So with almost perfect timing, Time magazine declared the stock market as dead in about 1981. And then it took off. So let's go back and take a look at the index again, and I'm looking between 1915 and 1999. And what you get is something you can say strongly exponential growth period. And Sharp's paper was published at this time using the data across that range. Now you notice there's actually a period of fairly stable growth, and it's actually above the trend of the market over the 80 or so year period I'm looking at there. So there's the paper published at that point. And if you look at the fit of the capital asset pricing model of that data, it's pretty good. Then the crash of 1973 occurred, and prices fell 45% in 23 months. There's the peak. Now it might not look like it, but in log terms, that's a pretty severe fall. It falls from 1,052 to 578. And then a bubble began, and I can now clearly call it a bubble, in 1982, and except for a couple of disturbances in 1987 and in 2000 and now recently, it kept on going up that bubble level. And now if you look at where the market got to in 1999, it was about 21 years ahead of its trend. And I think we can say pretty comfortably after what's been going on for the last 10 years that it's the best you can say it's tracking sideways. And the CAPM fit isn't so fantastic anymore. Now I think this is a repeat of the same slide where I'm putting in new data and using a new program. So I'll just let that pass right through. I'll fix it up for next year's lectures. 20 years ahead of trend, so same sort of story. Now, why is it? Well, why did it take so long to happen? Is really the interesting question, because for CAPM to actually describe reality properly, everybody has to maximise utility. That you've got to all be doing the same thing of making a trade-off in risk and return, and the stock market has to follow a random walk with drift. Now, I presume that's still taught in the other finance courses here. Okay, it ain't a random walk with drift. We'll go into that in more detail in a couple of lectures' times. Now, I've shown you how experiments challenge the individual interpretation, and most people breach that risk-return trade-off, which is where behavioural finance came from. So I'll talk in more detail about how the stock market's data compares, but what I want to now do is say, well, let's see how people tried to cope with the fact that people didn't behave as the theory said individuals behave. Unfortunately, even though these people are critical of neoclassical theory, even they get it wrong in looking at von Neumann and Morgenstern. And there's now a whole literature misinterpreting the misinterpretations of neoclassicals, of what von Neumann and Morgenstern actually said. So they had all sorts of explanations, like the ones we got from the class, like risk aversion, for example. So here's your choice again. You've got those two odds, and the rational person, blah, 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 chooses B rather. Most people choose A, and the first explanation, oh, that's because of risk aversion. So you actively dislike risk, so you choose the one that has no gambling to it. But it's fairly easy to show people also do what is called risk aversion. So in some cases they'll take the risk averse choice, other times they'll flip over, reverse their preferences rather, and go for the risky choice. So here's another one, do nothing, or a gamble where you've got a 50-50 chance at toss of a coin, win 150 or lose 100. Okay? Now most people here chose B, but the majority choose A. Here's another one, lose 100 for certain, or have a gamble where you've got a coin toss chance of winning 50 or losing 200. Now, I'll let you pop over that one just for the sake of time here. That's the risk-averse choice. You choose A in both cases. That's what actually that's what you might call risk-seeking. Most people choose A in the first case and B in the second. So saying they're risk-averse doesn't explain what they do. So most people look like number 3. And that's irrational. There's a risk reversal going on. You risk avoid in one case, you risk seek in another. So it didn't make sense either using a neoclassical attempt to understand it or the von Neumann numerical terms, because you get reversals coming out of that as well in numerical terms. Now, and I'm going to now show you how this works out numerically as well, because von Neumann's axioms were used to interpret people's behaviour at this level, even though they're using subjective probability to do it. So you have, if you choose A over B, in that case, and you've got to say the utility of 0 is greater than the utility of a coin toss between plus 150 and minus 100. Now, using those axioms that I showed you at the beginning, where you can separate out the probability and multiply the probability by the utility, you can rewrite it that way and say the utility of 0 is greater than 0.5 times the utility of 150 plus 0.5 times the utility of minus 100. Now, if you choose B over A in the second problem, then you can say the utility of minus 100 is less than the utility of 0.5 times utility of 50 plus 0.5 times the utility of minus 200. Now, that is inconsistent because the axioms are linear in the sum. So just take a look at what's going on here. The only difference between this setup here and this set down here is $100 has been taken off it. In each case, that's 0, that's minus 100, that's 150, that's 50, that's minus 100, that's minus 200. So according to the axioms, that involves a reversal. Now, let's take a look at it. What you get out of that is to say in the first case, the utility direction is that way, and in the second case, it's switched. So you've got that goes from being a greater than sign to a less than sign. Now, that is actually hard for most people to accept, because I think, why is it so that if you add $100, you shouldn't change your cursor, but in fact people do. It looks like cheating to a lot of people. So I can show you a single experiment with the same result. Now, here's problem 3, and I'll get you to work this one out. And this is a one-off choice, by the way. You don't get a chance to do it 100 times. It happens once. So for sure, I take $45 off you. Or B, a coin toss between losing 100 or losing nothing. Okay, so which one do you go for? Work it out, write your choice down. Do you go for A, 45 bucks for sure, or 50-50 of losing 100 or nothing? Okay. And problem 4, let's say I give you a 10% chance of minus 45 and a 90% chance of nothing. Okay? Versus a 5% chance of minus 100 and a 95% chance of nothing. So which do you choose there? You choose A or B? So, who chose A in the first case? Who chose B? The majority go for B, okay. Who chose A in the first case? Who went for B? You've all done too many finance courses, okay. A is the rational choice in both cases. Because you do your calculations, you get minus 45 versus minus 50, minus 4.5 versus minus 5. But what most people do is choose B and then A. That's, again, what tends to happen with people that haven't done a finance degree. And that gives you a reversal of expected utility, and it's easier to show that. Because if you choose 3B, that's what you're saying in utility terms, and I can then expand it using the axioms to say the utility of minus 45 is less than half the utility of minus 100 plus half the utility of 0. If you choose A, I can then expand it out and say 10% of the utility of minus 45 is greater than 0.5 times the utility of minus 100, with those utilities of 0 turning up as well. And I can subtract those from either side because I'm working numerically here. So I then get this outcome, and I can multiply that by 10 to get that outcome. Now you compare it to the first option. People choose 3A and 4B. What you get is, in the first case, you get that 1 times utility of minus 45 is less than the utility of 0.5 times minus 100 plus 0.5 times the utility of 0, and you also get that it's greater than. Pardon me. So there's a better, easy to understand or accept illustration of that reversal going on there. But is it a reversal? Again, look at what von Neumann and what Morgenstern first said. They said you should be using repeats. But let's say I give you exactly the same choices again and say whichever one you choose is going to happen 45 times. Oh, sorry, 100 times. So A, you lose $45 for sure, or B, you've got a 50-50 chance of minus 100 or plus or 0. So which do you choose there? You've got to do it 100 times. The first case, for sure, you lose $45 every time. In the second case, what happens if you choose the gamble? Most likely, you're going to lose $5,000 overall. In the second case, if you choose the first outcome, you're going to lose $45 1 in 10 times, times 10, so you lose $450. Or in the second case, you're going to lose $55 1 in 10 times, and lose a larger amount of money. So you do your calculations. If you actually sit down and work it out, you'll lose less money by choosing A both times. So what you have is, again, it's applying something that works for risk, applying it to a situation of uncertainty. Now, von Neumann, as I said, were very clear that there could be a problem in making the comparisons, but they weren't looking at it to handle one-off choices. If they were told this is how people were going to use the theory, I think they may have decided to write a different book. Now, you've got to consider uncertainty, okay? And that's the mistake. There's a whole lot of literature about what they think like they call the Allais paradox and so on, after the person who first invented it, one of these utility reversal paradoxes. They're not paradoxes when you do it multiple times. People's behaviour, if they sit down and do the calculations, will conform to those axioms. So it's a case of misapplying the literature, which is one reason why I don't do what most courses in behavioural finance do, which they spend all their time playing with these paradoxes and trying to understand them and working out curved trade-off function between loss and gain and so on. I think it's all a waste of time, because if you look at the original literature, it wasn't how you were supposed to use these ideas in the first place. And it's all coming down to this, by having subjective probability rather than objective, it comes down to confusing uncertainty with risk. Now risk, anybody remember Donald Rumsfeld's famous comment about known knowns? Okay, most of you are too young to know that one. You're lucky people. You didn't have to put up with Donald Rumsfeld on the TV. But one time, Donald Rumsfeld, who was the Minister for Defence, responsible for getting us into the Iraq War and all the very confident expectations about how many weapons they'd find and how fast the battle would be over and how wonderful the whole thing would be. Defending himself in a press conference, he talked about, well, there are known knowns, there are known unknowns, there are unknown knowns, and there are unknown unknowns. And that's about the only sensible thing he ever said. He got ridiculed for it, but it was sensible. So if you look at the roll of a dice, how many outcomes are there? Unless you've got a really weird throw of the dice, you've got 6 outcomes. It could end up on a point, but that's ridiculously unlikely. Betting a football game, well, you can use recent form. And all you can do is win, lose or draw. There's no fourth alternative. Uncertainty is where we are now in the unknown unknown case. There's an unknown chance of being one of a possibly infinite number of unknown outcomes. And they can be things like, will a rival firm beat you to developing an invention? Will you or somebody else discover a cure for cancer? Will new technology make your current invention obsolete? That's uncertainty. Will Wall Street crash in October? That's a bit closer to a certainty. Okay. We've got plenty of techniques to handle risk. The odds, probability, stats and all that sort of stuff. They're based on known distributions and the ability to repeat the experiment time and time and time again, as von Neumann wanted their objectives to be used. But uncertainty, you don't know what's going to matter. Now there are better quotes than Keynes on this one than I've got here, but Keynes made the case back in 1937 about what is and is not uncertainty, and he said roulette is not uncertainty. The prospect of a war is uncertain, writing in 36, the war started in 39. The rate of interest in 20 years' time, or the obsolescence of an invention. He said about those things, we have no information on which we can base any calculation. We simply do not know. But even though we don't know, we still have to invest. Okay? If we decided to be paralysed by inaction, we'd still be back in the trees. So how do we handle that? Now, I don't regard what you get taught about in finance as investment. What you get taught about is how to gamble on the stock market. Okay? And when you do that gambling, you're getting people to buy shares of another gambler. 99% of the time, or even more than that, the shares you buy aren't issued by a company. They don't give anybody any money they can use to actually go and build something that might make something else, which is what investment really is. So Blatt, who's the guy ideas I'm going to be using this part of the lecture now, calls that placement, which is close to calling it gambling, and placing your bets on the table. But you're not actually causing any investment. So I don't think you're taught anything about investment in conventional finance courses. What you are taught to some extent is how do you value an investment by a firm, and how do you take account of the fact that as well as the time value of money, you've got to also take account of the future being uncertain. And one technique you'll get taught in conventional courses is the risk-adjusted discount rate, where you apply a higher discount rate than just the straight one for the time value of money to also say, well, maybe the future won't work out the way we expect it's going to. Now, imagine you're drilling for oil in the East Timor Sea, and your weighted average cost of capital is 7%, but your main risk, really uncertainty, is will the Indonesians try to take over the oil rig? Will the East Timorese finally get even for all the lousy deals the Australians have forced on them and nationalise the rig? Will there be an earthquake on the line in which the ground in which your pipe goes into the crust? How do you cope with those? Now, what the risk-adjusted discount rate does is say, well, let's put a higher discount rate on. Let's say we double it, and then see what happens, and decide whether you go ahead or not under that situation as well. So imagine it costs $1 billion to build the rig, and you've got cash flows of $200 million per annum for 10 years as your expectation once it's finished. So if you use the risk-adjusted rate, or use the standard rate, you come out with a valuation overall of $404 million, positive net present value, you'd go ahead. Apply the higher discount rate, you get $43 million, it's still positive, you'd go ahead. So what actually happens if disaster does strike and it gets nationalised in year 4 or 5? Well, the cash flows stop. I've actually got 1 year too few shown there. I should have one more number. And you get negative cash flows in both cases. Okay. But that's that sort of thing, a cash flow abruptly stopping at some time in the future where you're still presuming a positive one. That's what really goes on with uncertainty. But the risk-adjusted rate doesn't take account of that. It simply continues discounting years 6, 7, 8, 9 and 10 when if disaster strikes, they don't exist. So it doesn't help you. And Blatt, in the book that I put as one of the readings on the course, and anybody who wants to really learn economics in a non-orthodox way and very deeply, I recommend reading that book. He talked about the payback period. Now, have you heard about what's called the payback period in your finance courses? Yeah, what do they say about it? Yeah, that's what it is. How long before you get your money back? But what are the observations the textbook and the lecturers make on the payback period? Do they recommend it or say it's not a good idea to use that method?
They say it's an okay idea to use it. You've got two methods to use. One of them basically they say you add up the payments.
Yeah.
And calculate how long it takes, but it's not recommended, but you can use it.
Okay, not recommended, but you can use it. Is that in finance courses or in accounting?
Finance.
Finance, okay. And I'm going to show you that what's usually said is it's not a good idea to use this approach. So the focus is on risk in conventional analysis, where low variance means low risk. But what actually is going on in that example I gave you a moment ago is not variance. Variance isn't the problem. It's uncertainty and the possibility at some point your cash flows are going to be cut off. And variance there is irrelevant. What really matters is avoiding negative returns. So risk, as a person in finance really means it, is the risk you'll get zero returns or negative returns at some point in the future. And it's quite possible that somebody else's phone, can you turn it off? Thank you. High return can actually mean low risk. So that's looking at risk as variance. In that particular situation, I'm looking at exactly the same thing, but comparing CAPM versus the focus on uncertainty. There's a low return. There's a low risk because you've got a very, very tight distribution. There's a high return, there's high risk. So you'd say, well, the riskier project is the one with a higher return. But if you look at it in terms of the point of view of the odds of disaster, I haven't actually properly illustrated it there clearly, but you can see the zero line is there. So there's the fraction of that less variance distribution, which is negative. And there's the fraction of the high ones that's negative. So your odds of a disaster are higher, even as using your own calculations, for the one with a lower return. So it's confusing. You should be looking at the downside risk, not the variance of the actual distribution. Now, one way to go about this is to say that, well, disaster is unlikely to happen on day one of an investment. To do that, you've got to be a really good Australian bank. Did you see this stuff a couple of days ago, where 3 Australian banks funded some British health firm? $150 million, and within 3 weeks it had gone belly up. That's pretty impressive. But normally, if you make an invention now, you're unlikely to have somebody coming out with a new one straight away that wipes you out. For example, does anybody here own a Walkman? Okay, where is it? You don't know where? Somewhere inside the house? Okay. Who owns an iPod or an iPhone or an iPad? Okay. Now, Sony, of course, got wiped out by this new invention coming along, but it took Apple a while to do it. So even though Walkmans have been eliminated and Sony's lost its dominant position in the recorded music industry, it did get wiped out at some stage, but it made cash in the meantime. Of course, the other thing is, the longer you wait, if you're in a boom, the more likely you are to be in a slump. So therefore, you should somehow discount more future cash flows more heavily than you do immediate ones. Now, the simplest way to do that is to say, well, the odds of disaster start off at zero and rise linearly with time. That's total simplification, but it's better than ignoring uncertainty completely. Whereas the risk about adjusted discount rate and net present value just use the same discount rate all the way through. So I'm saying rather than just having R as your discount rate, maybe you should have R plus B times T, where B reflects the growing probability of a disaster in the future. Now, that's the discrete form for the net present value calculation. You've got your expected value, happens to be the inflow of each particular year, divided by 1 plus a discount rate compounded, and added up over time. In continuous time, it looks like that. So I'm going to use continuous time because this is how Blatt derives the argument in his book, Dynamic Economic Systems. So there I've got cash flows as a function of time, and there's your discount rate as e to the power of minus r times t. Now, Blatt's point is that disaster will mean rather than having infinity at the top of your integral, you're going to have s, where s happens to be the time where disaster occurs. And therefore your cash flow cuts off at that point. And his argument is that you can argue that the simplest way to say is, well, all cash flows are zero. Of course, they'll be, if you look at the Gulf oil disaster, cash flows are seriously negative for BP after that disaster hits. So even there, it's a simplification at this stage. But you can say S can be any time between t equal to 0, which is like our banks. 3 weeks is pretty much 0 in terms of years, to t equal infinity, where there's never a disaster. And you've got to sum that over all the possible values of t. So the way you do that is say that disaster at time s is going to be, the odds of disaster at time s are going to be b multiplied by s. And if you integrate that, your discount factor is now 1/2 bt squared. Okay? You apply that discount factor as well to the net present value calculation, and what you get is that expression. Now, it takes some seriously complicated integration to get to that point. Don't try doing this at home unless you want an exercise that'll get you a degree in the Khan Academy. But that term together now gives you an expected value that's discounted not just for the weighted average cost of capital, but also for the possibility of disaster striking at some time in the future. So there's your expected value when disaster is taken account of. There's your standard formula, and there's the extra adjustment for the probability of a disaster happening. Now, because that has a t squared term in it, and multiplied by a constant, that's going to start off small but rise very rapidly over time. And ultimately, it'll totally dominate the discount factor. So if you look at giving a value of 5% for both R and B, then that's where you just look at discounting cash flows over time. That's where you include the disaster probability in terms of how much weight you give to a return in 10 years' time. And after 10 years, you're still taking account of 60% of the terms with just the net present value calculation. With the disaster one, you're only taking account of 8% of your estimates then. So it cuts off these future flows and says, don't take them seriously. Now let's say there's two projects, both cost $100 million, and A's got an idea of zero cash flows to begin with, and it rises by 25 million each year until 8 years, then it stops. B's got $50 million a year all the way through, so starts high but doesn't grow. If you use a net present value rate of 5%, what happens versus including a disaster probability? Well, in continuous time, where your end is t, is 8, what you get is a net present value for A of 362 million. Do it for B, what you get is 229 million, or $230 million. So A is better than B. But if you include the disaster probability, then A gets you 120 million, B gets you 123. So you reverse the ranking by taking account of the possibility of disaster. And it also gives you a much lower level as you saw the net present value alone because of that impact of uncertainty on the whole situation. And you get almost the same thing with discrete formulas. Now I'm just showing them on the page here. I thought I'd change that animation to get rid of that. But that's just showing the same sort of thing applies. And B becomes, A is the hands down winner on net present value alone. B comes out ahead if you look at uncertainty as well. So there's your net present value formula in continuous time or discrete time. There's the uncertainty aware formulas. Now that's not much help, even though it's more sensible, because clearly the one with uncertainty is much more complicated, but the thing is, how do you work out a value for B? The value for R, you work out your weighted cost of capital, that's easy. For B, how do you do it? Well, I'm now going to show you that Blatt worked out a way you can actually map B, which is an unknown known at this stage, into something you can actually derive from what businessmen themselves might talk about, and then you could actually do something seriously useful for a firm deciding whether to invest under uncertainty. And he finds ultimately it's related to the payback period. So it comes out saying rather than being one you shouldn't use, he's saying it's actually better than net present value because it takes into account not just the time value of money, but also the probability of disaster in the future, therefore uncertainty. Now, what he says is there'd be, let's say that the payback period's M years, might be say 5 or 6 years. Well, even with that, if you're running a large number of investments in a corporation, even though you say this has a payback period of 5 years, you'll say, but some projects are going to fail, even though we think they're going to make it to the payback period. How many of those can we handle failing? What percentage of projects can actually go bad, even though they meet the payback period? Well, he said, well, that you can relate to the probability of disaster striking before M happens. And this is the Matzes and Blatt in 1983, and I linked to it in the lecture here. But that's what's got me puzzled. I thought I saved that to the course here. I'll have to, I mustn't have copied the lecture over properly. What you get is this relationship where you can actually replace the B by t squared for time over t squared for a finite time in the future. And that t in the future is the product of the break-even period divided by an expression involving the maximum number of projects that you're actually happy to have go bad. That might be, say, if you're a very conservative firm, that might be, say, you've got to have 19 out of 20 have to succeed. That's the sort of thing that a trust might have. So if you had a payback period of 5 years and you said you wanted 95% of your projects to succeed, so only 5% could go bad, then you'd have a T of 2. If, on the other hand, you had a 10-year payback period and you could handle 25% of the projects going bad, your T would be 6. So you'd actually go and ask a business those quite sensible questions, and on that basis you could then say, okay, I can now give you a way of taking account not just of the time value of money, but also uncertainty. And T is a bit like a horizon of uncertainty. It's a subjective time in the future when you just don't take account of what comes in after that period of time. So M gives you your maximum acceptable payback period. D shows the maximum acceptable risk of disaster happening before then anyway, as a percentage of your overall projects. Together you get T out of that, and that gives you those uncertainty-aware formulas. So again, this isn't part of my assessment for the subject, but it's something which I think is worth knowing if ever you actually get work in a firm. So the reality is, though, the conventional finance again disparages what businesses do. Because most businesses, when you actually see somebody seriously putting their money on the table, they do calculate payback periods. And this is how Gitman, which is the textbook I was forced to use when I taught standard finance courses, talks about it, saying it's generally viewed as an unsophisticated budgeting technique since it doesn't explicitly consider the time value of money. And the Wikipedia, I'd love to have somebody to go and edit this one and include the references from Blatt. Wikipedia says it's serious limitations and qualifications because it doesn't take account of time value of money, risk financing, opportunity costs, etc., etc. In fact, when you look at it carefully, it's more sophisticated, but it includes not just the time value of money, but also uncertainty, even though it isn't explicitly put in those terms. And I'll go into a lot more detail on what uncertainty is and how we cope with it in next week's lecture.